The second US interest rate rise has been delivered on cue, but offshore, stock markets and bonds have largely taken it in their stride. What does it mean for asset classes here in Australia? And what do we take out of the recent low GDP growth but strong jobs data released locally? The US rate rise to 1.25% was very well anticipated, and so no great surprise that markets are relatively stable. Despite the background political noise and impeachment risks, the US stock market is still near record highs. The Nasdaq Tech Stock Index has retreated a little from its recent record level, but the Dow Jones is clearly through 21,000 now, which is fairly impressive given it is in the face of rising interest rates. And other countries, including Canada, are talking about shifting to a tightening bias in official interest rates. So the global reflation trade does seem to be back in vogue. Meanwhile, the UK is licking its wounds after the indecisive election result, and talk now of soft Brexit versus hard Brexit. But we have seen better data out of Europe, where the European Central Bank has removed its easing bias. And, rounding out the offshore developments, the most recent Chinese data has beaten expectations, with imports surging over 22% year on year, which is great news for Australian exporters, and a slight surprise given the recent falls in commodity prices, albeit off elevated levels after the rally earlier in the year. There is still uncertainty over how China can achieve its soft landing, especially with high debt levels and associated policy tightening, but this data was encouraging. Back home, the main economic data was GDP growth, which fell to 1.7% year on year, but was still positive for the March quarter. So, we've officially entered our 26th year of economic growth. And it was interesting to see that while real GDP growth, after stripping out inflation, was very low, nominal growth was actually much higher. Analysts suggest this is mainly due to a surge in company profits, although wages growth is still very low, which might explain why business confidence and consumer confidence seem to be diverging. Business conditions in the NAB survey are still well above their long-run average, but consumer confidence fell to its lowest level in over a year. Meanwhile, unemployment fell in May to 5.5%, with a 42,000 rise in employment. Very impressive. So, a mixed bag locally, but overall, we expect bond markets may weaken a little as global rates rise. The housing market has steadied and hopefully can retain this stability, but stock markets here need to play some catch-up, having lagged overseas markets for much of 2017. Until next time, that's the market update from Bendigo Bank.